Hi everyone, welcome back to Be Rich. I got Shashit with me to explain about what was happening on the Friday in the market. All of us experienced the market on Friday seeing it negative, and we saw selling across the board. And all of us were expecting when we opened to see the details of trade from the FIIs and DIIs that at least one of them would have been selling heavily if one is buying. But we found this strange thing where we saw a total of 6,500 worth of buying done by both DIIs and FIIs. DIIs were the bigger ones who bought for 3,500, and the FIIs almost bought for 3,000. And a lot of you are asking me and wondering if FIIs are buying so much, DIIs are buying so much, but the market was negative. And we usually see this correlation between the negativity of the market and the positivity based on how the FIIs buy and sell and the DIIs buy and sell. If this is the case and both are positive, how come the market was 1% negative when we closed? And there's a little bit more to this story. Yes, sometimes block deals, like I've said in the past, can make a difference. But there was no significant huge block deals to create this kind of a wave. So I thought Shashwat can dive into this and explain how retail investors play a role equally and how high net worth individuals play a role equally. And of course, talk about something which we usually don't talk about, which is the derivatives and what are derivatives and how they impact a market. Okay, Shashwat.
Yeah. So buying and selling data is, yes, one thing. You have the absolute number of the total net buyers, net sellers. You look at buying volume, selling volume. All of this is fine. But the point is that finally, regardless of the number of buyers and sellers, it's the price at which a trade is agreed upon. And if the price at which the trade is agreed upon is 1% lower, it's 1% lower. There's no two ways about it. If today there are 10 buyers and 6 sellers, and we decide that the price is 12 rupees, tomorrow there are 20 buyers and the same 6 sellers, but both of us agree that the price is 5 rupees. Fine. The point is there are more buyers than sellers, and generally when there are more buyers than sellers and there's greater trading volume for in the side of an optimistic side, that is more buying rather than selling. But my point is, regardless of that, the price which is agreed upon can still be lower. That's one. And also, it doesn't really matter how much DIs and FIs are buying and selling on a daily basis, because a 1% movement here and there is, practically negligible for long-term investing. But regardless, let's look at derivatives and futures and options basically as a topic as well. Because now that we're looking at micro movements, it's important to also cover what the futures and options markets are doing. So a simple way to think about future and options is that they're weapons of mass destruction. That's what Warren Buffett talks about. He says that if you don't know what you're doing with FNOs, you're going to lose a lot of money. And if you do know what you're doing with FNOs, you're still going to lose a lot of money. So the reason why we don't talk about FNOs on this channel is because I personally have not engaged with FNOs, and I have not been burnt by it. But I trust my uncle when he tells me that, look, they're weapons of mass destruction. Warren Buffett has said so. And he has personally seen many people lose a lot of money through FNO. In fact, I've seen a lot of my friends who got into trading very recently. Once they turned 18, they got into FNOs and they made a lot of money in long-term investing, but their derivative trading went very poorly and they lost a lot of money. They made plays on huge companies like Reliance, which has done decently well, but they still lost a lot of money. So there's no reason why long-term investors should be doing it, because it's pure speculation. But that being said, let's understand what futures and options are. Futures are basically a contract to buy something at a certain price in the future. It's as simple as that. There are two sides to it. A person who can guarantee the future contract, that is, a person who puts up the future contract. I tell you that, look, I'm willing to sell you a certain stock at a certain price in so and so days. And you in return say that, okay, I'm willing to take on the other end of the deal. So you're making a price correction deal. And the thing with futures is you're forced to make the deal at the end of the time period. So you can either settle in cash or you can ask for the product to be delivered, and you can get the product delivered. Generally, when we look at commodities, it's settled in cash, and if we look at stocks, it goes both ways. It can be delivered or it can be done as a cash settlement. So when we look at futures, one important thing to understand is that it's a speculation play. So when you say that I'm going to buy TCS at 4,000 rupees in the next year or so, you are making a speculative play that the price is going to go there. Today's stock price might be, 3,500 or something, and you expect in a year it's going to climb to 5,000. Maybe you don't have the cash right now, the liquidity right now to purchase TCS, but you believe that in a year it's going to rally all the way to 5,000. And if you can secure a buying price of 4,000, for which some people are willing to offer, their future contract, that is take on the other end of the deal, then happy enough, you're happy to take the deal, and then in a year, regardless of whether the price goes to 5,000 or not, you have made a commitment to do that. So at the end of the 1 year period, the deal goes through. You can ask for the stocks to be delivered, and basically you pay for whatever you had agreed upon. Now, the other type of derivatives which are available are known as call and puts. So if you look at calls, they're basically an option. And like the name suggests, you have the option of buying something with a call at a certain price at the end of the period. So the idea of a call option is that suppose you agree on a strike price of 30 rupees for a stock ABC, and the stock ABC, you have the option of buying it at 30 rupees at the end of the period. You're not forced to buy it. You can let the contract expire without ever encashing the contract. But you have the option of doing so. Unlike with futures, where you are forced to go through with the deal. And with the call option, you pay a premium for given this option. Because who in their right mind is going to give you an option for free? If I gave you an option for 0 rupees cost to you, we would all be happy to take more and more options, because what we learn in economics is that the more options you have in life, the better you are, regardless of whether the options end up actually being useful or whether you actually take the option or not. So you lose nothing by having the option, but there is a cost to the option, which is the premium that you pay on the option. So for me to have the right to buy ABC stock at 30 rupees, I have to pay you a certain money to make it worth your while. And if you look at the put option, that's the flip side of it. I buy an option which gives me the right to sell XYZ stock at 40 rupees or whatever rupees at the end of the period. I don't have to sell it to you, but if I choose to sell it to you, you have to accept it and the deal goes through. And for this option as well, I pay you a small amount of money, whatever the premium is, and I pay you that money, and we both take on each side of the deal. So, on the basis that is off the top of the head, it doesn't feel like such a bad thing. But the problem with future and options becomes the fact that you can leverage quite a bit. You don't actually have to have 100% of the money to be able to write a future contract for that amount of money. For example, if I'm writing a future contract worth 30,000 rupees, I don't need to have 30,000 rupees worth of stock with me to be able to write that contract. I can write it with a percentage of that 30,000 rupees, which means that I'm effectively making a play for a larger amount of money than I can actually afford at any given point. And secondly, it's a purely speculative play. There's no fundamental analysis going on. You're not purchasing a company, you're not becoming a part of a business, you're not working to build something from the ground up. It's practically a speculative analysis where you're saying that tomorrow I think the price is going to move here, I'm willing to take on this end of the deal. And the other person is also making a speculative analysis and they're taking the other end of the deal. The point is, when you mix leverage and speculation, it ends up leading to financial ruin, only because in the short run, it's very difficult to predict where the market is going. Not very many people can do it. And how the people who do make money from F&Os, there are some people who do make money from F&Os, very few, very rare, but there are some people, and very recently it blew up on their face. But there are some people who make money from futures, and those are the people where they look at a future contract at, let's say, trading at 150 rupees per stock ABC, and the actual stock price is 100. Then they try to bridge the gap. That is, they say, I'll buy the stock at 100 and I'll cover it at 150 and I'll pocket the 50 rupee into my pocket. Generally, such premiums are not worthwhile unless you leverage quite a bit. And if you do end up leveraging quite a bit, you risk the price moving against you and you requiring more collateral. And what ends up happening is you have to unwind the position at a loss. And if you unwind the position at a loss, the rest is, something which we can all imagine what happens. You end up going bankrupt at the worst case. So something which recently happened in the US was the price of the S&P 500 moved against a lot of futures traders very rapidly. Even the treasuries, a lot of people made plays on treasuries where the future premium was about point something percent, very small amount, which they leveraged about 50x, 60x. I think a Japanese firm leveraged 80x on it, and they went completely bust. Hedge fund went completely bust because they leveraged 80x on a 0.5% premium, and because they thought that it was a safe premium to make, and the market moved against them. Donald Trump did what Donald Trump did best, the US president, and the hedge fund basically lost a lot of money. I'm not saying that every future and option trader is going to lose money the same way, but the point is that when the market moves against you, if you're leveraged, it's going to be very difficult for you to manage. So, what do you think about this future and options thing?
Yeah, I just want to give everybody a little bit of context, the future and options. Why do we have it? If Shashwat says all this, Warren Buffett says it's weapons of mass destruction. So if it's such a terrible thing, if it's like drugs, and if it's like, cigarettes, why do we have it? We should just remove it and ban it. There is some sound reason why we have futures and options. There's history to it. In any business, what we want is predictability. When you look at a company to invest, we want to see predictability on future earnings, right? So how does a company work? How does a business work? A business takes some input material, does something with it, and in turn sells it on. So they take something, add some value to it. After adding value, they sell it on. So there's an input cost which is involved for all businesses, be it big business, small business. So there is that input cost. The businesses, as they scale up and grow, they need to know what is going to be my input cost through the year. Only if they can see through the year, businesses as they grow, kind put things into place. Okay, this year I expect my input cost to be going up by 6% or 7%. So then, in terms of my selling cost, I have to factor in my overheads. I have to factor in this. It's a process which logically, if you think, it makes sense. So future and what it does, it helps you secure your input cost no matter what happens in the market. So you're reducing your risk. Believe it or not, future and options is something that helps you reduce your risk. That is why FIIs, DIs hedge their bets, meaning they're trying to reduce their current risk. So let's say, I'm a guy who sells biryanis, and I need every month I spend 100 kilos of rice. But I know this year the rains are going to be bad thanks to the weather, climate change. But I need the rice also in the month of December, October. So what I do, I go to the farmer and tell him, boss, I want to make sure whatever you harvest in December and October, I'll buy it from you. Tell me the price I can pay you so I can book my place. So the farmer might say, what, 100 kilos of rice, okay, I'll give it to you for 100 rupees, you can take it. So I pay a portion of that 100 rupees now and I book my place. So out of the 100 rupees, I give him 10 rupees and say, okay. So when December comes, I pay the remaining 90 rupees and his rice, 100 kilos of rice, he'll give me. And this way I have stability in my business. So I know my input cost. What started happening is they realized this itself can become a business. So the farmer in businesses, what they realized, let's say the farmer places a bet to buy those 100 kilos of rice and suddenly there's a bumper crop, and rice is going to be sold. That means I can buy it cheaper. So then I try and sell off before December comes. I'll try and discount this and try to sell it off to get rid of it because I can buy it in the market for cheaper. Or there is no bumper crop, it's become a drought and the price is going to go up. Then I can sell it if I want for profit if I don't need it. These kind of ideas started creeping into people's mind. People are sitting doing nothing on days. So this idea expanded and has reached a stock market where every single thing you can put a future on. So you can place a future. That's what you're basically doing. From reducing your risk and trying to get predictability into your life, what is happening is you start placing bets. Like how you can place bets on which who will score the most runs this over.
There are things we have no business predicting, but we predict it.
Correct. So I can put a future option saying so many students will graduate computer science engineering from IIT Chennai this year. I can place a bet and people can take an option on it and say, I think you're right. Some will say I'm wrong. That's what's happening. And that's what Shashwat is trying to say. From it being something this is necessary for a business, to bring lower its risk and bring stability, it's being exploited, trying to milk it for money, which is where the problem is.
There are people buying. The funny thing is, there are people buying futures contracts for tons and tons of oil, crude oil, and the point is, imagine you get your crude oil delivered to you, like truckloads of crude oil coming and being placed in front. I mean, it's funny, but it's true. Like, you're buying because steel and those commodities are actually
It's happened in movies. They show those scenes.
Yeah.
What exactly they exaggerated how crazy it is.
Yeah.
In a movie, I forget which movie, the scene is there where the guy comes and says in a truck and says, "Where would you like me to keep your stuff?"
Yeah. So people don't realize the scale at which they sometimes are trade. If you spend a few lakh rupees in commodities like copper commodity futures, you don't understand the amount of copper or the amount of whatever you're making a play on, how much you're actually moving around. You're moving tons and tons of like commodity, and if you actually saw the amount of what you're actually speculating on, you end up realizing that, boss, I have no business doing what I'm doing.
Correct.
Unless you're a businessman, which is completely separate. Like he said, you book, and some of you might be wondering why people take the other end of the deal. Because if, let's say, he's the businessman and he's willing to give me a small premium and I'm the farmer, that money can be used in my business. That is, I can take that premium and use it to cultivate more crops. Because tomorrow, if I expect the price to go up and he expects the price to go up, I can produce more crops with the premium that he's giving me. That's capital in hand, which I can earn a return on. So if every 1 rupee he gives me is going to earn me 20 paisa on it, that's great. 20%. 20% return on every rupee means that I make money off of it regardless of what price I sell it to him. So it's a way of lending money as well.
You're correct. I'm getting free cash.
Yes.
So it's like what we spoke about, the company which did a momentum trade with Graviton, because they would probably sell some future tickets, get some free cash in, and they'll take it into a momentum trade, buy 1.7 million shares of Natco, raise it up when it goes up by 2 rupees, dump it, make 35 lakhs, and return it.
Yeah.
So there's easy ways to manipulate this, and there are people who do it, but it's pure gambling and speculation is what is happening.
Yes.
And it happens. But like in the beginning of the video, what Shashwat said matters the most. As a value investor, this is just nonsense.
We have no business doing that.
No, it is just nonsense.
Yeah.
Because it's not investing anymore.
Yes.
You're just trying to see if someone's dropped some few coins on the road.
It's a glorified trip to the horse racing circuit.
Yeah. So bottom fishing or whatever you want to call it doesn't work. All this, end of the day, is a distraction. Why do we look at it? There is some sense in looking at it to get some kind of what is everyone doing, macro trends. But diving down to it and thinking I should follow them and do that is crazy. Go back to your fundamentals always. Look at a stock. Is it of value? Is it a price which is a correct price? Does the business make sense to you? If all those boxes tick, you should be investing. The rest of it, if you have so much of free time and intellectual capacity, read a book.
And might I add one more thing. Some people think that they can outpace the market and they can make a crazy momentum. All those things are nonsense, because people are spending millions and millions of dollars into developing algos which do millisecond, microsecond optimizations in trading. So there's no way that you or me could compete ever against those algorithms, and we shouldn't be competing against.
You shouldn't waste your time doing it.
Yeah, it's like going against a calculator and trying to compete with a calculator. There's no point. There are other things the calculator cannot do. Calculator cannot read this.
Yeah.
ChatGPT cannot read this, even though many people think that it can, but it can't. So there are things that we have a strength in, which we should be playing in, and futures and options, at least for me, and I know for you, it's not our area of strength.
No.
So we should stick to our area of strength.
Correct. So anyway, I hope that gave you some clarity on what happened on Friday. So does this have any implications on Monday? No, it doesn't. Because I cannot predict what will happen on Monday. If anyone who says they can predict such things,
good for them.
Good for them. I wouldn't follow them. I would rather wait till the market opens. We have a list of stocks we're looking at. If you find value on that day, look at different coffee range and exit. Do not go and throw your whole bank balance into the market. It's not a very smart thing to do. Even if you're thinking of gold, you'll be speculating if you're going to think gold is going to go to 4,000, so I'll buy it because Anand said it or whatever. That's not the way you invest. Gold is, first of all, not an investment class. Anyways, we digress. Thanks for watching the video as always. Hope you had a wonderful Saturday and you have looking forward to your Saturday evening as you rest and recharge and get ready for Monday. Thank you for being with us on Be Rich.
Thank you.